Tell me a bit about yourself, how you came to found Untapped and your journey, I guess.
Sure, sure. So I spent most of my career in tech. I graduated from Stanford undergrad and grad in the early '90s and went straight into tech. So for most of the '90s and 2000s, I was both working in tech and also investing in tech as an angel investor and also investor in various venture funds. But in 2010, I wanted to quote unquote do something more impactful. And I decided the right way to do that was to start volunteering. And at that point in 2010, it was right after the earthquake in Haiti. And so I went and volunteered in Haiti and quickly concluded that aid was actually not solving the problem. In the best case scenario, it was a band-aid for many of the issues. And in worst case scenario, it was actually prolonging the issues by not addressing the core economic challenges.
Hmm.
And perhaps because I'd already spent almost 20 years in business at that point, I decided that business was the best approach. And so I launched a company with the World Bank, the IFC actually, and the Dutch Development Bank, FMO. We co-funded a decentralized water infrastructure company in Haiti to serve underserved regions of Haiti with clean water. Model works. We serve close to 200,000 people today with clean water. But one of the challenges is that we always had, well, not always, but it was very challenging to find the capital, the right kind of capital to scale. And it was either these bank loans that didn't make very much sense, or equity financing to finance capex growth, which does not make sense. And there really weren't that many options, not only because of Haiti, but just because of the capital intensive business we were in. And so I really, and at that same time, I was doing quite a bit of investment in other parts of the world, including Africa. And I noticed that there's this really untapped opportunity to finance capital intensive businesses in emerging markets because of how broken the financial system was there. As I like to joke, you can borrow $500 to buy a cow, or you can borrow 20 million to set up a power plant, but anything in between, you're out of luck. That's where my company in Haiti sat, right? And I
Hmm.
discovered again that this wasn't just a Haiti problem. It wasn't just a water infrastructure problem. It was a problem across emerging markets with the financial institutions and the financial sector in general. Millions of entrepreneurs, millions of successful businesses were being excluded from the financial system because they were informal, or they were just the right size, that they were either too big for microfinance and too small for regular finance. So we set out to do this financing model that could very scalably provide financing to smaller businesses in a way that is both safe and high return. And the way we kind of arrived at that was a bit of an offshoot of my financing, or sorry, my investing work, because I'd be doing investing in equity in companies in Africa, and I would often come across companies a little bit like my company in Haiti, where I said, "Well, yeah, great company, doing a lot of great stuff. You're generating cash flow like crazy. I would never invest in that business. Why? There's no exits. It doesn't really scale that much. It's in a market that I'm a little bit scared of, at least from an equity standpoint.
Hmm.
You know what? Why don't we do some type of capex financing so that you can get the next 100 motorcycles so you can scale your business?" And so that's how I got into this revenue-based financing model that essentially allowed me as an investor to capture the cash flow returns of these businesses. And because the financial system is so broken in these countries, the returns were massive. Every dollar that I deployed would create $3 or $4 of value. So
Hmm.
it wasn't very difficult to convince entrepreneurs, like, yeah, you keep most of that value, but give me my 30, 40, 50% return, because they can't get the money anywhere else anyway.
Yeah.
And so it was a win-win that worked very well. And so we started down that route. And that's when we also realized that many of these companies were actually implementing technology in their business model. They're using sensors, they're using digital payments, they're using all sorts of tools to make their business run more efficiently, naturally, right? Everything's digitizing like crazy in Africa and other emerging markets. And so we saw this really, I would say, unique, once in a generation opportunity to do this type of financing, which is essentially asset financing, that with a revenue-based return with a technology base. So we would finance assets that are smart, i.e., that have a digital footprint, that have data coming from it about how it's being used, but also many times is being paid for or operated with digital payments. So now we say, we can do this financing model that makes sense, but we can use technology to scale it.
Mm-hmm.
And that's where I think that difference is, asset financing has been around. Smart assets have been around. You combine the two, combine that with digital payments, and what you've created is a way to finance a completely untapped market that is growing like crazy, which is this smart digital economy that is being run by small businesses, ordinary people, generating cash flow like crazy, solving basic needs like clean water, transport, irrigation, payments, etc. So we said, wow, this is an incredible opportunity to really transform how financing is done in these emerging markets, not just Africa, but in all sorts of emerging markets where the financing systems don't work. And there is a clear divide between those who have, i.e. have the jobs, have the assets and collateral so they can get bank loans, and those who don't have the assets and the W-2 or the pay slips where they can go out and get loans. Those people just don't have an option. Now they do. Now they can use the future work that they put in to get loans today so they can pull themselves out of poverty.
Yeah, and I guess this is a unique opportunity in that, as you mentioned, traditional banks haven't been catering to these people, and there's this massive slice of the pie now where I'm presuming they haven't really integrated these kind of digital solutions effectively, and now there's this amazing opportunity whereby, just like we see as well in Western markets, but to a far lesser degree because it's already far more essentially it's far more established. Here you've got a huge, basically blank slate in which to start your businesses.
Yeah, what's interesting is that whereas this may be tougher in developed markets, we're really taking a data native approach to risk management and underwriting. What you see with lending in the US that incorporates data, not all of it, there's some really innovative stuff. My apologies for the background noise. Sitting outside. But what oftentimes banks are doing is saying, oh yeah, let's improve our credit scores by using data. Well, that's nice, but you're still underwriting the same way, which is looking at people's balance sheets and getting their collateral and using a legal contract, and you're still sending a credit officer out there to shake hands with that person. But there's an opportunity in our markets to actually go full digital, full data natively. So the way we assess risk is using data at its core, not just looking at, well, gosh, give me your pay slips. I still don't trust you, so I'm going to put a lien on your house. And then we're going to use a legal contract to make sure that if you don't pay me. Our strategy is designed for emerging markets in a data-driven world that is natively designed to ensure that we get repaid at high rates.
Mm-hmm. Awesome. Yeah. I mean, rated that, can you give some examples of the kind of businesses which Untapped have invested in?
Yeah, I'll give you three that are quite different. So we finance a lot of mobility. So we got started once with a partner called Flex Club, and they did car subscriptions for Uber drivers. Because if you're in an emerging market like South Africa where they operate, in order to get a car lease, you have to have all the trappings. You have to have a job. You have to have credit scores. You have to have a history, right? So they instead took driving scores, Uber driving scores, to assess the quality of the drivers, and based on that, gave them a car subscription, which we finance. And so we use the car Uber ratings on an ongoing basis and the fares collected to ensure that we get paid.
Mm-hmm.
And so now,
so you're almost piggybacking on Uber's own metrics there.
Or using the data they provide, right? Exactly. And And that way they can finance the scale up of their business, Flex Club that is, so that they can serve not just thousands of drivers, but hundreds of thousands of drivers. And now with Flex Club, we're doing delivery services and all sorts of different things in both South Africa and Mexico. Another example are I can give you a bunch of names, but we have almost a dozen different electric mobility providers. And similar to Flex Club, we're basically providing a vehicle so that the driver can earn cash with that vehicle. But what's interesting about electric mobility is that it's highly complementary to smart asset financing, what we do. Because as you may know, the total cost of ownership of an electric vehicle is much lower than your typical petrol, about 50%, some would estimate. But it's lower because you have lower maintenance costs, you have lower energy costs, you have lower blah, blah, blah. But you, as a Kenyan motorcycle taxi driver, not that you might understand it intellectually, but you might not be able to realize it because, well, gosh, if it costs me more to buy it up front, then I'm screwed anyway. But we're able to use smart asset financing to essentially transform the per kilometer costs of that vehicle to be less than what it would be for petrol, and allow you to pay just that. So you can imagine if I am a motorcycle taxi driver, instead of paying $1 a day for it, I can pay just 80 cents a day. And we're even making more margin. Everyone wins, including the environment. So we are shoring up a whole ecosystem of electric vehicles that essentially allow us to provide drivers with essentially electric vehicles at a lower cost than petrol or gas vehicles, which hopefully will accelerate the transition to electric. And we're doing that across, we're doing that in Ghana, in Uganda, in Kenya, in South Africa, and hopefully many other countries.
Mm-hmm. Well, why don't you explain exactly? I know you sort of.
Oh, give me a third. Let me give you a third example, which we're also very proud of. This is an example. I might even give you a fourth example. So in Nigeria, we finance solar-powered pay-as-you-go refrigerators. So a small merchant will take a refrigerator and it cools their drinks and the food that they resell and so on, but it's solar-powered. And instead of buying the refrigerator and paying the electrical company, which in Kenya it's intermittent anyway, you pay per hour they use the refrigerator. So now I, as a small merchant, can get, let's say I don't have a refrigeration. Now I can suddenly get it and pay for it by the day, by the hour, in fact. And we get repaid directly from the machines because it's all pay-as-you-go. And we get all the data from how much the refrigerators are being used or not being used, etc.
Mm-hmm. Yeah, awesome. I mean, you touched on repayment there. I was just wondering how does that process actually work? I mean, does the money go direct to you, or is there an intermediary between? You have the asset provider, you have
so the operating partner, as we call it. So there are different models. In some models, we collect the money first, actually, because of the pay-go system. We even manage the payment systems, and then we distribute the monies as per contract to all the parties. So if you will, as long as the machine's getting used, we get paid. And in fact, that's the way we started, and that we did everything. Then we realized that actually that's too rigid of a model, because there are many operating partners who were providing assets to, let's say in this case, it was a grocery store, and there's a water treatment system. Well, they're not going to run away, because if they run away, they're not going to get any more financing from us. The grocery store is not going to run away. They can't. They're a grocery store, and that machine can't just disappear. So we said, well, gosh, we'll just take all the data, and you just pay us what is owed, and they essentially collect from the grocery stores. And similarly, if the grocery store doesn't pay, they just take the machine away. So yes, there is a risk, but the risk is 1 month of non-payment, right? And so we decided we've relaxed that. So we essentially rely on the operating partners for the most part, based on the data that is provided to us through the systems. We data integrate directly with their systems, and then they repay us based on how much they sold with the data set.
Mm-hmm.
And we're quite happy with that, because again, that operating partner is a long-term relationship. They're not going to run away.
Mm-hmm. And less work for you guys as well. I
Less
mean,
work for us. And yes, there is a risk of non-payment, but that risk is quite small.
hmm
If we do $1 million financing, if they fail to pay 1 month, we recover everything, and everything's we basically are out 1, maybe 2 or 3 months, and that's it.
yeah. I mean, it seems as well, another huge advantage is if you supply the asset itself, obviously if the business does poorly, you can always recycle the asset and use it elsewhere.
Exactly.
So that
So in a
covers,
sense, our default rate is technically zero, although I think that's misleading to say that, because what happens is we move the asset whenever it's the only way that it defaults is if the asset is destroyed.
mm-hmm. So yeah, talk me through how you essentially, what does that process look like in terms of obviously a successful business? It's easy. We can just provide more assets over time. But if something's not going so well, how do you approach that?
Yeah, so let me actually start from the beginning because I think it's useful to talk about our underwriting process. So when we first come across a potential operating partner, we'll provide a small check to assess a couple of things. One, how good the real unit economics are. There's always what's on the Excel spreadsheet and what's in reality, right? So we assess it in reality, and we data integrate with that partner. So we get full data integration into their system, so we see the data coming in real time, along with the payments. And so that's much harder to fake in that sense. You can only fake so much of that. And then we will provide another check, a larger check, to assess how quickly or how well they can deploy capital at some level of scale. And so with the first 2 runs, and that might just take 2-3 months for that to happen, we've assessed 3 key pieces. How good is their data, and how good are they technically, number 1. 2, do the unit economics support? Is there enough margin in it to support them, to give a good wage to the operators, and to deliver our returns? And 3, can they deploy this capital at some level of scale that is good for us, good for everybody? And if the answer is yes, then we'll do a larger check. And we may even sign a big deal with them, let's say a $5 million deal. But even in that $5 million deal, we have the recourse or the ability to say, if you don't meet your IRRs, we stop funding. And as you can imagine, there's a constant cycle of money coming in and coming back to us. And so if you actually do a theoretical 24-month lease or a 24-month term with the money deployed over 36 months on many, many different assets, the maximum amount you have is about 40%, 30 or 40%. That's your maximum exposure. And even then, you might only lose 1 or 2 or 3 months. So our actual maximum exposure, if they're like the worst thieves ever, is still only 3 to 4% of our total deal that we make. So we really minimize that whole risk by essentially doing it in an iterative fashion, but using data to drive our decision making. And we do it in a way that is just-in-time capital for our partners, which is good for them, because no one wants to take the money and just hold on to it, paying for it, but also allows us to pull back or increase based on the data that we get in real time from our partners.
Mm-hmm. Awesome. Yeah, I mean, you talked about how you go through the process of essentially constructing the deals with these operating partners. How exactly do you find them? I mean, do you have boots on the ground? Is it people reaching out to you? I mean,
yeah, great question. So we have a team all across Africa, in the north, in the east, and the south. We still don't yet have a person based full time in the west, in Nigeria. But one of our investment officers is Nigerian, and another spent many years there. So we're on the ground, and it's really important to be on the ground. And on top of that, I've been investing in Africa for quite a while, so myself and my team are quite immersed in the ecosystem there, the investment ecosystem. And what we do wouldn't be possible without that immersion in the ecosystem. So that's really important. So the reason we aren't, going, hey, let's do a deal in Indonesia, and here is we're not there, and we don't have the boots on the ground, which is an important aspect of the risk management. That said, the demand is so high that we have so much inflow of potential deals that deal flow is not the issue, right? Now, obviously, vetting the deal flow is a important one, and I've already explained how we vet the deal flow. But having the people there and just cutting through the bullshit is an important aspect of it as well. So, if I were to answer your question more concisely, it's people on the ground, a good understanding of the markets that we're investing in, and just the fact that the supply and demand is so off kilter. There's just so much demand that people are just tripping over themselves to get this kind of financing.
In demand, huh?
Yes. According to the World Bank, the financing gap for SMEs in emerging markets is $5.2 trillion. It's massive. So, I mean, everyone recognizes this as a gap. And the funny thing is, it's not funny. Everyone recognizes it as a gap, and everyone's trying to address it. But few people are changing the model. Everyone's just throwing more money at it, as if there's a unnatural reason as to why this is broken. And I'd like to point out that there's a financing gap in emerging markets, not because there isn't enough money. There's actually enough money. Well, maybe not to fill the whole gap, but there's enough money to do a lot more financing of that missing middle than it's getting there. The issue is systemic. The issue is that the way most lenders lend money doesn't reach that missing middle. Now, Muhammad Yunus came up with this incredible model of banking the very, very, very poor and created a revolution in microfinance. Okay, it covered one part of that spectrum. But that model also didn't change how underwriting was done for larger loans either. So most microfinance institutions are lending just like banks do. So the reason banks don't lend to those groups is very systemic. It's, oh gosh, does it really make sense to spend $1,000 to sending a credit officer out and doing due diligence on a deal for a $10,000 loan when you're going to spend $1,000 doing the loan? It just basically means you have to charge 30, 40, 50% interest rate.
Yeah.
Which is punitive. So that's the issue. And until you actually change how you manage risk, who gets money won't change. You can even change who gives the money and who invests the money. If you don't change how you invest the money, it won't change.
Yeah, you're talking about the dynamics of risk there as well, and I guess we'll go on to the revenue financing model, which you talked about. But from I guess the operating partner's perspective as well, if they're the ones who finance their own business completely, they buy the capital, they take the loan. If the business doesn't work out, for them, that's a huge risk which they're facing. Whereas obviously if they're scaling with third-party capital, that also limits their exposure as well as yours by the fact that you own the assets themselves. So
yeah, and it's a really good point. Essentially what we're doing is we're putting ourselves in the same boat as the companies that we finance. And for many financiers, it's, whoa, that's scary risk, right? We don't have this guarantee projection of taking away somebody's house. But, we temper it with this rolling database due diligence model and using data to really assess the risk. And what we're not doing is going and saying, Toby, I like your business. I've never seen it before, but we'll finance it. We're not taking that kind of risk. We're saying, yeah, motorcycle taxis. Yeah, there's 1,000 in Nairobi already. Okay, we know there's the demand for another 500. Okay, we're going to take that business model and use IoT to monitor it, but we can relatively safely predict what each motorcycle is going to do. And again, we use that data and the IoT to track that on a regular basis. So in effect, we're mitigating the risk with data, but putting ourselves in the same boat or taking on that risk from non-performance. But at the same time, that allows us to get much, much higher returns than what we can do with just debt without putting that burden on the entrepreneur. Because the entrepreneur pays only when they make money versus interest, which is, wow, business didn't go so well this month. You have the bank banging on your door saying, why? Right? And that's ultimately the conflict of interest that doesn't get resolved.
So why do you think that this revenue financing model is works so well in emerging markets, and why, at least in my experience, we haven't really seen it so much in other economies?
Well, I think the reason we don't see it as much in the U.S. is the capital markets in the U.S. are quite flush with cash and quite efficient. You can, depending on the state that you're in, you can get money no matter who you are practically, right? It's just how much interest you want to pay. And so there is a relatively good working system, but mind you, there's some really interesting data-driven financing models out there. One of the inspirations for what we do today is what I saw 6-7 years ago with Square, where they would use the data from the POS systems that they would provide and give instant loans to cafe owners. Well, if the cafe's turning over $100,000 a month, a $10,000 loan is nothing. The likelihood of them suddenly running away with the money with $10,000 and shutting down the cafe is nil, right? Very, very low. So people do that already. Or there's a lot of hard money out there in the U.S. where people give these revenue-based loans, and then based on the revenues that you generate in your business, they'll take it directly out of your bank account. Not dissimilar from what we do, right? Now, it isn't tied directly to your sales, but it's not a far leap.
Mm-hmm. Yeah. All right. So a bit of a segue now. It's all been good news. I mean, what's the biggest sort of challenge or obstacle which Untapped has faced so far, and how do you...
So there's a common question that people ask, and people often will say, well, is it fundraising or is it deploying capital? And my answer is neither. I can go out and raise a big check, big lump of money, but then deploying that right away is challenging. And if I don't deploy it right away, I have to sit on it. I can go and find $100 million of deals, but then I won't have the money to service them, and then I lose all those deals. The challenge really is growing both sides at the same time. Having just enough money to deploy to meet our demand, and vice versa. And so this is where I'm very much looking at the crypto world as a perhaps solution to that, in the sense that there's more liquidity and faster liquidity in the crypto world than in the conventional worlds. So whereas I don't necessarily want to take all my money out from the crypto world, because I think the return expectations are higher, and by the way, we're able to service the higher return expectation. I don't want all my capital to be coming from the crypto world, but I can use it to basically provide, or to smooth out my demand curve, to ensure that I always have the capital to be able to deploy when I need it, so I can grow it like this. So in a sense, I see the crypto world or crypto investors as a credit card. Yeah, sure, I'll pay the much higher yield, but then once I can replace it with a longer term, lower cost debt, I do that. And then I do it again. And everyone's happy, because those who are yield farming get their nice return and get their money back safely. And I use the crypto world to smooth out our capital growth. For
sure. I mean, there's one thing in that is that I assume to invest in Untapped, essentially, well, for retail investors, it's always a huge challenge to be able to invest in the same kinds of opportunities. I mean, we're talking about expanding financial access here, but there's also the other side of that coin, that a lot of people can't invest in products like this. I mean, is crypto for you also a way to maybe access that market in a way which wasn't previously possible? And certainly,
yes, but we do have to be careful, right? I mean, I think the retail investment rules are there for a reason.
Yeah.
Right. Our goal here is not to issue a coin and say, hey, everyone invest in this. We want to follow compliance as best we can. And look, there's nothing about U.S. SEC compliance regulations that say you can't use crypto. Of course you can use crypto. You just have to do everything that you're supposed to do. Right? You have to register a security. You have to, if you want to work under Reg D, you have to ensure that you do your KYC and that investor is an accredited investor. You can do those things and still use crypto. Where I think there might be some interesting opportunities is that in the jurisdictions where retail investing is allowed through crypto compliantly, that we do that in those jurisdictions through crypto, because it is a more nimble and a more, I think, appropriate investment instrument for what we're doing. Because ultimately, I mean, I could argue that what we're doing is the original vision of decentralized finance, right? Changing who gets to invest and where the money goes. And we're channeling capital towards asset types that otherwise would never get financed, because we're using the data to create these transparent contracts to link investors and investees. Mm-hmm. That is the ultimate goal, I think. Or not, I mean, some people would say to buy a yacht, but for many, it's the ultimate goal of DeFi and Web3. It is to change who invests, how they invest, and where the money goes. And I think that's what we're doing.
Yeah, I mean, I think there's even an opportunity in there for, say, currently you own the assets, but it's still essentially a quite heavily intermediated process. I mean, if we're talking about Internet of Things and such, essentially these assets could be directly programmed with contracts which pay out investors directly. Therefore, they're not even relying on Untapped as the facilitator, but essentially they create the contract, people can invest to raise the asset, and then the asset comes with its sort of predetermined sort of
Don't outcome. Tell anyone, but that's our goal. I'm sorry, we're being recorded. But anyway, it's that is our eventual goal. Look, I'm one way we could have done this was to build a crypto platform and try to do that right away. We decided not to do that because we can do this through a conventional route, through fiat, and still be very effective. And ultimately, the technology platform is important. But what is, I think, equally important is this vetted base of operating partners, vetted stack of assets that are producing value. And we got to create that first. So we decided let's put that together first. Let's build that to a certain level of scale that is significant and interesting. And then let's layer in the technology on top to make it more efficient, versus building technology and saying, hey, boom, we want a $100 million pot right away. Because garbage in, garbage out, right? If you get shitty deals coming in, then you get shitty returns, right? Whether you're hiding it because of how you're doing your tokens, that's just eventually will happen. The piper will need to be paid at some point. But if you have value creation and strong assets, how you sell it, whether it's through fiat or crypto, that's just a secondary question.
Yeah, and to be honest, I completely agree in that. As much as it's a bit of a corny phrase in this space, we're still very early. The infrastructure isn't really, I don't think the infrastructure is really there to efficiently interface with the real world. All the potential is there, but realistically, until governments start really getting to grips with the issue and things get standardized, things just become easier as a way of doing business, that's when opportunities like this will truly unlock. And we're trying to push it that way, but we're not there yet at all.
Yeah, I mean, it's really early, and I look at this and it reminds me of the web 1.0 in 1995. We're still taking this new medium and applying it to the old world. Newspapers in 1995 were still just putting their newspapers on the internet. They don't even realize what's possible with the interactive features until Craigslist comes along, or a Medium comes along and disrupts how you do publishing, right? So I think there is a bit of that, but what I also see is there's a lot of noise that's coming along with it. When you think of crypto, you think, oh yeah, billionaires, crypto, Bitcoin millionaires or billionaires with yachts in Puerto Rico. Yeah, there's that, and people are speculating on crypto and making money on it or losing money on it in some cases. But
Yes.
I think the real value of DeFi, of Web3, will start to come into focus when we start connecting decentralized finance or open finance with real world assets that are creating real value. Unless we want to live, breathe, and do everything in the metaverse, we have to connect. That's where the real value is when we connect that OpenFi, DeFi, whatever way you want to call it, to real world economic activity, which is what we would like to do for emerging markets.
Yeah, I mean that is the goal. That's the dream. I'll go through my list, but I think we've sort of covered everything. Not quite in the pre-planned order, but yeah. Oh yeah, here's another one. What are your? I mean, we touched on it briefly, I guess, but what are your sort of imminent plans for the next 1 to 2 years? I mean, what does it look like?
Well, it's to really continue to grow our asset base and our network of vetted operating partners in the countries that we know well. So to do that in Africa, carefully examine other markets as well. But there's a lot of growth left in Africa, so we don't have to go anywhere for a little while, to be honest. And really establish a solid set of solid capital deployment runway that can generate really strong returns for investors. At the same time, to start exploring these new ways of raising the capital. That's for retail investors. We just launched a retail investment platform on the fiat side. You can go to Untapped Global, untapped-global.com, and create an account and start investing in these assets right now.
And you don't have to be an accredited investor?
You do have to be an accredited investor. Yes, indeed. You do have to be an accredited investor. By end of this year, we should be able to allow non-accredited investors to invest as well on that platform. Well, that's upcoming. But we also want to include institutional investors who I know will be interested in the portfolio of electric mobility assets we have, for example, and sell them a securitized version of our portfolio. We want to be able to work with great partners like Gluwa and offer crypto investors a way to invest in these assets. And so we really are looking just to expand and consolidate the different sources of capital so that on the other side, our operating partners, because we've established this long, stable runway of capital deployment, they can leverage all the work that we're doing centrally to gather up this capital in a way that's on demand and efficient for them. So ultimately, though, we really want to work side by side with companies like Gluwa and get a clear understanding of what DeFi and OpenFi can do for real world assets. And say, look, this is, sure, you can go and stake your money and on something very speculative, on whatever, but why don't you earn maybe just as much, or at least a lot, and stake it on something that will actually feed 1,000 families. Taken on creating value in a place where people want to work, people want to earn money, and all they need is a little bit of that capital given to them in the right way so they can go out and earn that money. Perfect. And I believe that, I hope that will resonate with many people in the OpenFi, DeFi, Web3 space.
Definitely. I think that's the future.